Hi, and welcome to Investment Banking University, where we teach you how to become an investment banker. This is, of course, our capstone course, How to Become an Investment Banker, which is taught online as well as in a weekend format and in a month-long training. So we are going to be going through the course today. So we're going to start with the overview of the course and talk a little bit about why, in fact, we're talking about the topic of investment banking. So investment banking is, of course, the sell side associated with the perpetuity, this selling of a perpetuity. And we're going to be discussing investment banking in the context of perpetuity science, which we pioneered at Investment Banking University. So we're going to open the discussion with the contents of the course. We're first going to be talking about perpetuity science, the reason that we have investment banking, and we're going to be talking about the perpetuity methodology, namely the three sides to the perpetuity, and then we're going to ultimately end up getting into the different phases of the perpetuity as well within that. From there, we're going to be talking about the foundations of valuation, which are going to help link together the different sides of the perpetuity. So we're going to start with the tracking of value, which is accounting, the analyzing of value, which is finance, and ultimately modeling value. From there, we're going to get into the first side of the perpetuity, known as the build side. And within the build side, we are, of course, having a key question, how to build a perpetuity. And there are two sub-questions below that, how to build a benefit stream and how to de-risk that benefit stream. And this is, of course, the role and responsibility of the CEO. And then we're finally going to get into perpetuity management after the perpetuity has been created. This second side of the perpetuity is known as the sell side, and this is where we directly talk about investment banking, the reason you're watching this course. And we have our own proprietary how to become an investment banker methodology, which is broken down into several steps. We're going to be talking about the middle market, M&A multiples, the investment banking coverage methodology that we've created, as well as an M&A origination methodology. Within that investment banking coverage methodology, we touch on something known as mandate target matching, and we have a separate methodology for that. And then we go into deal structuring as well. While on the sell side, we are, of course, going to be running the M&A process associated with the selling of a perpetuity. And for those of you that have had some experience or are going through investment banking university, you may ask the question, how do I, in fact, build a boutique investment bank myself to be able to do M&A myself? Well, we have a methodology for that as well, and we'll be talking about that within the course. So after the firm building and management portion of the course within the sell side, we're going to be talking about the actual deliverables and coverage for investment banking. Finally, we're going to be talking about the third side of the perpetuity, which is known as the buy side. And of course, the key question there is to how to buy a perpetuity. We answer that question with the principle of investing. And then we have to tailor our analysis, which is using an operating model, for whether or not we're a financial or a strategic buyer. Of course, for a financial buyer, we're going to be dealing with an LBO, and then for a strategic buyer, we're going to be looking and utilizing a merger model. And then we're ultimately going to wrap that up with in addition to portfolio theory in the context of perpetuity science. And then some of you may ask the question, in addition to building a boutique investment bank, hey, I may want to participate in private equity myself someday, so how do I start a lower middle market search fund? And we're going to be talking about that, and that's an important question. So we are ending the course with cases, and we're going to be talking about cases from three different perspectives, of course, associated with the three sides of the perpetuity, the build side, the sell side, and the buy side. So as for an introduction to the course, there are many investment banking texts out there that claim that financial modeling and valuation is the core work of the investment banker. This is simply not the truth. The core work of the investment banker is origination, mandate target matching, and deal structuring. It should follow that a text or course on investment banking should be based upon the same. It is the good fortune of the reader and the student of Investment Banking University that they have encountered such a book and course, Investment Banking, M&A Origination, Execution, Financial Modeling and Valuation, and the course How to Become an Investment Banker explains origination, mandate target matching, and deal structuring, i.e. how investment bankers actually make their money, and that's a key question. For those new to investment banking, you're first going to want to clarify whether you would like to work on the sell side for a few years or actually pursue a career in investment banking. The skills that you will need to get started in investment banking are different than those that you will need to have a long and successful career in investment banking. The role in investment banking transforms from one that is research, financial modeling, and valuation based into one focused on, of course, origination and the facilitation of the M&A process. M&A, mergers and acquisitions, is the core product of investment banking, and the other products, advisory and capital raising, simply support this. We founded Investment Banking University to prepare students for both bulge bracket and middle market investment banking career opportunities, as well as to give them the freedom and the option to venture out on their own and do M&A themselves. We see a paradigm shift occurring in the field of investment banking. The idea that you need to spend 3 years of your life as an analyst doing 80+ hour work weeks building financial models to simply become an investment banker is in fact a faulty paradigm. The real value added of an investment banker is not financial modeling and valuation, but rather origination, mandate target matching, and deal structuring. You, in fact, don't need Goldman Sachs' permission to be an investment banker, just like you don't need McKinsey's permission to be a consultant. Investment banking for private companies in the middle market is a great way to build your initial coverage and career as an investment banker without sacrificing a family life or, in fact, your health. So we have our first and our core how to become an investment banker methodology right here, which begins with coverage, goes into target screen and origination. Then the third step is mandate target matching. The fourth, deal structuring. The fifth, buyer-seller meeting logistics. The sixth, adjusted EBITDA calculation. The seventh, valuation. The eighth, purchase agreement drafting and structuring. The ninth, offer analysis. The 10th, due diligence and data room. And then 11th, closing and flow of funds. And we're going to be talking about each one of these steps. So we're beginning the course with a methodology that we've created, which is the synergy or the synthesis between industry and the capital markets. And that is, of course, the perpetuity. And so we're calling it perpetuity science. And within perpetuity science, there are, of course, 3 sides to the perpetuity. The perpetuity touches 3 sides. Touches the build side, the actual building of perpetuities by entrepreneurs and corporations. The sell side, the selling of perpetuities, investment bankers in Wall Street. And then the third side, which is the buy side, the buying of perpetuities by private equity or corporate M&A. So we're going to begin perpetuity science by discussing how education is currently structured in a business school and how it should be structured. So the standard MBA curriculum in most business schools is broken down along siloed subjects such as accounting, finance, management, operations, and marketing, and attempts to teach students how to be mid-level manager at a corporation for the rest of their lives, a functional siloed specialist, if you will. Unfortunately, these jobs are mostly gone, having been shipped overseas or automated. This MBA curriculum is thus outdated and not appropriate for the 21st century, when most individuals will have multiple jobs and roles throughout their careers and lives. So we're going to draw a distinction from this current state into what should be taught, which is, of course, perpetuity science. The more appropriate field, which is yet to make it to business schools, other than investment banking university, is known as perpetuity science. Perpetuity science is the body of knowledge, methodologies, and optimization models related to the building, selling, and buying of perpetuities. It explains how perpetuities can be built, managed, and exited from to create wealth. Perpetuity science is a paradigm shift in business and finance education in that it replaces the siloed subjects taught in undergraduate and graduate business schools with a holistic methodology that integrates the capital markets and industry into one framework. Instead of a disparate business taxonomy along the lines of economics, finance, accounting, marketing, we have an initial taxonomy broken down in relation to the perpetuity, namely the build side, the sell side, and the buy side, which we've already talked about. Within each of these 3, we have various methodologies and optimization models that may in fact touch on the various subjects such as accounting, finance, and economics. But by starting with perpetuity science, the student can better synthesize the various moving parts of industry and the capital markets. It gives them a context within which to understand the larger picture. When first learning about industry and capital markets, one should understand the nature of the perpetuity, which is the basis for industry and capital markets. The perpetuity can be modeled with the following formula. Perpetuity value equals cash flow over R, the discount rate, where cash flow represents the benefit stream associated with the perpetuity, and R represents the discount rate associated with the perpetuity's risk of receiving that benefit stream. So, as we just talked about, the perpetuity can be modeled with this following formula, CF over R, and this is going to be very important to understand because CF really represents a benefit stream. Aside from mathematics or anything of that nature, we really need to understand the nature of the benefit stream itself, as well as the variability in that benefit stream, which is represented by R, and that's how we can understand that formula in a very simple manner. So after understanding the nature of the perpetuity in general, we can then analyze the nature of the perpetuity within a given industry. The nature of the cash flow, the benefit stream, R, the variation in that benefit stream, and the value chain and value being offered will in fact be different. We investigate each industry according to these variables by building an index for the industry and then a subsector index within that industry. After building the index and the subsector indices, we can then begin analyzing the value chain and leaders within each part of the value chain. We will in fact be doing something called benchmarking, and benchmarking means separating companies into groupings based upon the phase of perpetuity that they're in. We then can build financial statement models for the leaders in each section of the value chain and understand the drivers of performance. We analyze each leader or target in relation to the phases of perpetuity in terms of where they are at now and the steps that are needed to be taken to move to the next phase. In doing so, one begins to think in terms of being a CEO. The CEO's role is to bring the company or opportunity through the stages of the perpetuity by building recurring benefit streams, i.e. cash flows, and at the same time de-risking those benefit streams. In doing so, the valuation of the perpetuity moves from a backward-looking towards a forward-looking, and that valuation is thus maximized, which means it's based upon a multiple of future earnings. The CEO should thus be familiar with perpetuity science and the phases of the perpetuity, of course. As the perpetuity changes, the formula for valuing the perpetuity changes as well. There are 5 phases of perpetuity building. As we move through each of the phases, the role of the owner of the perpetuity becomes more passive, and the valuation becomes larger due to the size of the EBITDA increasing, the EBITDA multiple increasing, and the discount rate decreasing, and the perpetuity becomes less dependent on the owner to exist and run as an organizational structure is formed, coinciding with the division of labor, processes are automated, and revenue becoming recurring. So here we have the 5 phases of the perpetuity, and as you can see, the formula actually changes according to where you're at in the phases of the perpetuity, with the lowest valuation beginning with step 1 and then the highest valuation with step 5, diversified. So the first, of course, is syndication, which means getting to PMT, our first payment. The second is job shop, from PMT1 to PMT2 to PMT3, etc. And then the third, where we're actually getting to be a perpetuity, is the transition from PMTs to cash flow. And that is from disparate payments into a durable benefit stream modeled by CF over R. Thus, we've gotten to perpetuity. The growing perpetuity is the 4th step, where we transform from the formula from CF over R to CF over R minus G, where G is the growth rate, which actually decreases our denominator, increasing our value. And then in the fifth step, we have diversified, which we think in terms of perpetuity 1 plus perpetuity 2, and we'll talk about what exactly that means. And then as an individual who becomes a perpetuity scientist, we of course have perpetuity analysis. And the key questions are what perpetuities to create, how to advance a perpetuity to the next phase, perpetuities that should be exited from, and perpetuities that should be in fact be purchased. And we're going to be talking about how to identify each one of these. And so on the next video of the course, we're actually going to be going into the perpetuity scientist as well as the functional specialist.